I just realized, geez, I want to get that um, on recorded here. That's incredible. So you bought Berkshire for the first time on Black Friday, 1987. That's incredible.
I've been watching it for a while and had planned to buy it. It just kept going up, and it had gone up to about 4,000. And I thought, wow, that's a lot of money in 1987 for one share of stock. And they didn't have as you know, they didn't have the B shares at that time. So it was either an A share or nothing. It dropped 2,700. I thought, well, that's a good time to buy some shares.
Good for you. That's awesome.
Still have all the shares too, by the way.
Yeah, I was just going to ask you that. That's wonderful.
I picked up. I was going to say I picked up a lot of B shares since then.
Do you go to the annual meetings?
You know, I haven't. It's been on my bucket list to do that, and I'm familiar with Omaha. I went to medical school there, so I've had the privilege of reading a couple of Warren Buffett's letters and partnership letters, not shareholder letters, partnership letters, which I don't know if you've had a chance to do that, but unfortunately, I didn't have the requisite knowledge. I wish I would have read them today because I would have gotten a lot more benefit out of it today than I would at that time.
Yeah, those are some incredible letters. Yeah, I have read the partnership letters. I think they start in what, 1957. I'd love to get the first one, but
yeah, I saw the ones from the early '60s before he bought Berkshire Hathaway.
those are great. Welcome, Michael. Or Misha. Oh, I can't hear you. You're on mute, but that's okay.
Hi, nice to see you.
Good to see you too. Well, why don't we jump in? I'm getting some feedback here. Why don't we jump in? Always like to start with the issue that I just released, and then we can kind of just open it up and talk about anything. So I kind of took a different, I'd be curious to get you guys' feedback for those who have read a couple of issues. I kind of took I called it the scuttle blurb approach this month. And, with the FDIC and all this information sort of already there in table form, I said, geez, if I'm just recreating this stuff, why do that? I might as well just kind of save my energy and just kind of put it into the narrative. So how did you guys like the scuttle blurb format, if you will? Any opinions either way?
No, I haven't read it. I'm sorry.
That's okay.
I actually liked it because I think, like you said, all the information is available. I think hitting the highlights and particularly for banks, efficiency ratio, return on assets, return on equity, what their value proposition is. It makes it a lot easier for us to be able to read your letter and your comments as to why you think it's a valuable to put on the watch list. But I have to say that 3 times, even though the return characteristics aren't bad, 3 times book value is pretty high for a bank. And you'd have to go a long ways to convince me that was a good buy. Even at 2 times is more like fair value for a really well run bank. They have a tremendous efficiency ratio, and I assume that's because they only have 2 branches, but it is attractive in that regard. But 3 times is pretty high, even though they have I think 1.8 times return on assets and 19% on equity, which is not bad, but not worth 3 times. But I'm interested to hear your other comments.
Yeah, I don't think it's worth 3 times book. I think I said it's not cheap, but I think it's worth. It was just an interesting little bank I came across. I said, geez, this is a nice little thing. There's barely any information on it. Based down in Georgia, south of Georgia. Just again, kind of put it on your radar if it became stupidly cheap might be something to dig in more at the time, make sure nothing's changed, and kind of scoop it up. Where it's on under $100 million market cap. So and that's kind of the premise of I try to find things that are undervalued if I can. I mean that's my day job, but if I can't, I'm okay finding these pretty good companies and just kind of watching. Um, yeah, that I thought it was a pretty good bank, pretty well run bank. I wish there was some more information on it. That was the only thing that um, even even at 2 times, I don't think I'd pay that much for that bank just because you don't have all the information that's out there. Whereas the Bank of South Carolina, a little bit more information, but not as good of a bank, I thought. Still really nice, steady earner, but not quite the caliber of uh, THVB or I mean Hingham. Hingham is always my benchmark for a bank. I mean, talk about efficiency ratio. Theirs is in the 20s. So incredible bank. Have you guys heard of these?
What
Oh,
what
go ahead.
what what um what thinking do you have in regard to population growth in this process? Because population growth of South Carolina and specifically Charleston is the either the highest in the United States or the second highest. And um, and so, for example, another bank where we work with, South State Bank, was just bought about a year, no, 2 years ago from Atlantic Bank, and it's amazing how much in that area people really want, even though Chase has just moved in, but people really don't want to work with Chase, who are, let's say, who are locals. Chase is more for people who come from New York City and who've moved down there. But, a South State Bank and Bank of South Carolina are both very, very, how do I say it? If you want to do a deal in South Carolina, and they're always willing to do a deal down there, they'll help you. They'll work with you. They work very hard to do that. So I don't know how much you put in chart, in your thinking about population growth or decrease.
It's something I'm certainly interested in. I don't. I wouldn't spend a ton of time on it. I think for me, you want to make sure it's not a dying community, but I mean, at the same time, a one branch community that can't support another one that's sort of stable but small can be a really good bank. There's no other alternative. I mean, that can lead to some problems, of course. And then the flip side is true. If population growth is big enough that it attracts all these competitors, now you have the dynamic of inviting more competition, right? Like it's not always going to go to that bank. I mean, what I really liked, and even watching the interview that the guys at Thomasville Bankshares they posted online, just back to the basics banking. I mean, these guys are just relationship people. They know the players, they know the market, they know which corner to lend on, they know which guy, you know, stiffed the bank that's no longer there 30 years ago. I mean, these are the kind of things that you can't just come in and buy. Although, I mean, in some respects you can in terms of hiring away local talent. I've seen that firsthand. But
Well, to
um,
your point, so I know the guy's the CEO of Bank of South Carolina, and he was at TD Bank before, and he gave us a loan to buy a building. But to your point about other banks like South State, where we deal with a lot, we don't do a deal unless our banker there says yes. Because to your point, he knows where the bodies are buried. He knows who just stiffed on somebody else on this. And there's a lot to be said about that local intelligence as opposed to being pushed down. Hey, you need to make so many loans or you're out type of thing. So there's a lot to be said about that, and I agree with you.
Yeah, it brings up another interesting point. My gosh, I just lost it. Oh, you just made a the local knowledge, and if anybody in here owns businesses, or I mean, even if you don't need the capital, going to a bank for a loan, you're going to get basically a free kick of the tires of your deal, of your business, and it can be some very good conversations that come out of it. And some of the best conversations I've had, when I was in the banking world, just looking at different businesses, business concepts, startups. Not that we didn't always do every deal, but it's interesting just to kind of learn what's out there. But for those people that are on the other side, getting to learn the market, the players, who to watch out for, competition, all of that, and you can't really replicate it instantly. I mean, I think that's the thing where being in a local market for so long, you've lived in there, it's hard to replicate. Or I mean, if they come in, I mean, banks, in my opinion, they're selling money. You don't have a capital advantage, but you do have the informational advantage in terms of losses. I mean, a bank can come in there and just buy any loan it wants with low pricing, but you're going to end up with credit losses eventually. So, there can be kind of which actually that can be good for the bank that is losing the loan, because they come in, they can take all their bad assets off the books basically by selling it to or letting it go to the bank that's pricing things kind of stupidly. Steven, you have a comment, question?
Yes, I don't have any specific knowledge on these banks, but I used to live down there in Tallahassee, which is close to Thomasville, probably about 45 minutes away. And I agree Michael's point again that, I think that they feel like small towns, and to play golf in Thomasville, it seems like it's probably only, 75,000 people. And even Tallahassee feels like a small town. So I think there is sort of a sort of old boys network or local network again, where when I was banking down there, I just worked with Capital City Bank, and now I'm in Atlanta with Bank of America. But down there, I definitely feel like, the smaller banks seem to sort of rule the roost in those locales. I can't speak for Charleston, but that's just my 2 cents worth again. And so I wouldn't think it'd be a particularly growing area, Thomasville, but there does seem to be a lot of old money there, and sort of a lot of people going there hunting and, again, just shooting ducks and things like that. It seems to be more money than you would guess driving through town. So anyway, that's my commentary.
Steven, to your point, one of the things that I've noticed about the bankers in Charleston is that they don't leave. Right. So, for example, our banker, who literally started from the bottom, has gone all the way up, and he doesn't want to go to the headquarters. He wants to stay in Charleston. He'd rather it paid less and know his community than leave. And that's what's very interesting about. I don't know if you experienced that in the areas that you were in, but the local banker guys, they want to stay there.
Yeah, that doesn't surprise me. I love the Charleston area, and I'm a retired ophthalmologist, but I go to the meetings again, and I'd rather go to that Kiowa Eye meeting on Kiowa Island than I would the national meetings, just because that low country, it's just charming, and just all the golf and all the activities, and I've got friends that have left Atlanta, go to Charleston, like, man, you should come join us up here again. So I agree with that. It seems like it has a lot of appeal, especially Charleston.
Yeah.
What I found really interesting, it was just happenstance that I did these two banks together. But Thomasville really reminded me a lot of the Illinois Bank and Trust, Rockford Bank, that Berkshire owned from 1969 to 1980. 60% market share in Thomasville. But what was really interesting, and I haven't quite figured it out, Bank of South Carolina, its market share was in the single digits. I kind of expected, okay, good bank, good, lower than average funding costs. They have sort of an average position, and maybe it's just the dynamics of the city, or Misha, if you have any particular insights into why that might be. I know there's some big players in Charleston, and maybe it's just the size of the metro area. I don't know.
No, what I really think it is that the guy who took over came from TD Bank, and he's not a local guy. And it's a lot about that. And the mistake, in my opinion, that they made was, so when TD Bank came into Charleston, the first thing that they did, and this is what they usually do, is that they try to get business. So what they'll do is they'll knock, let's say, 20 to 30 basis points off of a loan just to get you to just to go and be with them. And that's why, by the way, we went with them on that particular building that we were buying. And so when this guy left, I'm telling you, the other people, and he left to go over. He may be a good banker, I don't know, but I can tell you he is not locally known at all. And being from the north, I always make a joke that when I go to the south, I'm a carpetbagger, right? I get it, right? And so for me, that's why we rely so much on our local banker. Because he grew up there, he knows all these other people, he knows all the players. And what's interesting with Atlantic Bank, the bank's called South State Bank, but they're owned by Atlantic. What he does is that with all of the sister companies that they deal with, so when we did a deal in Tuscaloosa, he goes there and he actually vets the deal with the Tuscaloosa people, same type of thing. Who are the sellers? What's their history? Who are the renters? What are their histories? And it's really that type of information as a buyer and seller of real estate, where to me, it's the last business where there's imperfect information. It makes all the difference in the world. I mean, what attracted you to Hingham? I mean, Hingham's got to be has to have the same sort of characteristics, right? In that regard.
Oh, those guys are just incredible operators. I mean, to work with them is like working with some of the best real estate operators around. I mean, they just know these markets. They know all the players. They know all the things to watch out for, the good operators, and they just deal with quality people. I mean, I think Patrick Goggin has said they use the hand on the hot stove method of, they will go. And I've never seen this. This is just banks have a default rate of interest, typically 18%. Most never use it. Hingham is very quick to use their default rights, and it teaches people a lesson, and usually they either get out or they shape up. And if they don't, Hingham's getting paid for the risk. So kind of a win-win in that way. So just to be clear, Misha, were you referring to Atlantic Bank? The CEO came from TD Bank or Bank of South Carolina?
Bank of South Carolina.
Okay. How long has he been CEO? I didn't go that deep.
In 3 years.
Okay. Do you think they're buying business and that's how they're growing? I mean, do you think he's just kind of no?
No, I think the mistake that he made was that I think this is his thinking, and I can find out the truth in next week if you want, and I can report back to you. Is that somebody else would come in and buy them out? And so, in other words, if I just create these, I mean, the majority of the other locations that they have are literally they bought from South State Bank, who said we don't want to deal with that area anymore. You know, it was other places where they were getting out of, and you know, so I you know, the only way, in my opinion, that a local bank like that, other than its name, is going to survive is that you've really got to be, you've got to come from Charleston. You've got to come from Savannah, or you got to come from that area, or Beaufort, or whatever. It's local banking. Now, when people always talk about Volvo being there and Mercedes being there and Boeing being there, they're not there. It's a funny thing. It reminds me of Rhode Island, and that is why would I go all the way over there when it's 5 more minutes, right? That's too far. So for those guys at Boeing, they're on 26th. They're right off. They're at the airport, right? A guy from Boeing is not going to go down to downtown Charleston. So the top people at Boeing, they all live right up there, and so you know they're at Sullivan's Island or they're at some other place, but they're not coming down. So the big mistake that people make when they talk about the Mercedes and so on and so forth is that they're that extra 5 to 10 minutes away. People aren't going to go there. And to where these guys are located. So what's also interesting about Charleston is that if you think about it like a peninsula, right? So on this side, you have the Ashley River. Over this side, you have the Cooper River. On the Ashley side of the river, this is also Charleston. Well, in the last 10 years, this part of Charleston was 90% of the population, and this part was about 5% of the population. And then up here was the other remaining, right? Now it's completely switched around. This is 90% of the population over here, and this is about 5% of the population. So when I take a look at the map, I wouldn't want to be here. Everybody is moving out of here in terms of banks, and they're going out that way. And we call that the West Ashley. And that's where everybody's moving. And that's, if I were creating a bank, that's where I would do it. Now, the new banks like the Chases, it's really funny. They're all stupid. Like TD banks, they're all going that way across the Cooper, which is a different town, Mount Pleasant. And yeah, maybe a little bit wealthier, but nobody's going there.
What is so the and I'm just looking at a map. So West Ashley is the good place to be, or no?
Yes.
Okay.
That's where all of the type of deposits you want as a local bank, that's where you want to be. That's where South State is going towards. That's where it's really interesting.
Yeah,
so I'll give you. Sorry.
I was just saying, I think they have two. If I'm looking at the map right, they have two branches up that way, Baker, South Carolina. Go ahead, I cut you off. I'm sorry.
Well, no. But what's interesting, it's no different than and again, I don't know about other towns in the South, but it does remind me of this, and that is that you're divided by your hospital systems.
I know, but
And so the Medical University of South Carolina is going towards the West Ashley, and Roper's Hospital, which is a private hospital, is going towards it's going the other way. So again, it's no different. Everybody's trying to get to their own to what they think is their population. And in my opinion, if I were betting on anybody, but I am an insider on MUSC, I'm on the board, so sorry. But in my opinion, we're making the right decision because that's where the population is growing and growing fast.
Oh, that's interesting. I'm glad we have someone so well versed in Charleston. I drove through it, but I that's just about all I know about it, other than what I've
Come and visit.
read. And
Come and visit. We'll go play golf.
there we go. Any other thoughts on? Gone almost a half hour here on these banks. Any other thoughts on these banks? Comments, questions? You guys like looking at banks? I tend to be kind of bank heavy, I think, just due to my background. But in general,
I got a quick question. You know me, I don't mess around with banks too much, but I'm just curious, have you ever looked at BDCs or done any work analyzing those in comparison to banks?
Yeah, business development corps.
Yeah.
No, I haven't really looked at them. I've worked with some when I was in banking, but no. I mean, they typically, and correct me if I'm wrong, I mean, they're taking warrants and things like that. They might have some upside on some deals, getting into some riskier stuff, but
Yeah, I was just hoping you could tell me more of the differences of them. So I don't know much about banks.
oh, okay, yeah. I mean, and again, from what I understand, I think they don't have and I may be wrong on this. I mean, they certainly don't have their own funding source. They're probably relying on wholesale funding in some way. And then, at least the ones I've interacted with, they come in when they're not quite bankable deals. So they might have the bank might have a first tranche of senior debt, and then the BDC comes in with a subordinated piece at a higher interest rate. If there's not enough collateral there, they might take some warrants or some sort of upside on the deal. Banks are hard enough to figure out. I don't know if I could I could go down that path, but I haven't studied any of the public ones. I didn't even know that they really were out there. So could be fruitful searching there. Make a note of that.
Adam, I had a question on your, as you're researching these banks, it seems to me one of the more valuable assets of a bank are their deposit gathering. And we talked about, I know there's a lot of discussion about new banks, but the cost of funds is probably one of the more important factors that I would think you'd look at as you're assessing the banks, because it's a simple business. It's primarily it's net interest income minus your cost of funds is what you have to work with, or your non-interest income, which is your fees. And most banks, unless you're a Morgan Stanley or JP Morgan Chase or one of the bigger banks, you're not going to have a lot of non-interest income. And the other question is about the quality of the loans. I mean, how do you assess that? You can't see their underwriting. The only thing you can look at is their OREO, their bad loans, their loan loss reserves, that sort of thing. And it seems to me that without information, it's hard to look at a bank accurately. In fact, I'll throw out one that I invested in. I was thinking about it this morning. Silvergate Financial. It's SI. I don't know if you're familiar with that. They're based in San Diego, and their value proposition is they deal in cryptocurrency. Mm-hmm. They have the Silvergate network, which they act as a intermediary for transfer of funds between companies like Coinbase and River Financial and some of those to move funds in and out of cryptocurrencies. And all the return characteristics were great, and their loan loss reserves were great. And we didn't know is that they ran out of money because people pulled their funds. And it turned out, I mean, the high was somewhere in the 200s, I think, and they're down trading in the single digits now. And so basically it was a black box, and the return characteristics are great, but the actual performance wasn't so great for a variety of reasons. I just wondered if you have any thoughts about that.
Yeah, I'm not too familiar with Silvergate. I've heard about it. Actually, I saw John Maxfield, a couple of guys talking about it on Twitter. And John, if you're into banks, I mean, you definitely need to follow John Maxfield. I mean, he's produced some great charts, talking about some of these banks that have failed. That the graph looks like this, and then it's straight down, because those are the risks. And I mean, I spent 10 years inside of a bank. I was on ALCO committees, asset liability committees, um, loan presentation, executive committee, loan presentations, um, risk rating decisions, all of that stuff. They are black boxes, and yeah, they're regulated, but you can hide things, or not even hide things, just nudge things in a certain direction. Or I think that's where history really comes to the forefront. You have to have a long track record, a good track record, and they have to be the same people, right? If the bank's management changes, but it's the same bank, well, it's not really the same bank. I mean, qualitatively, and that's why for Hingham, and I just talk about this bank constantly, but Hingham, I mean, they've done all of the things that typically get banks in trouble, and have done the opposite, or put things in place to mitigate against them. One of which is, no one at Hingham has loan authority. It all goes to the board. Management owns a third of the bank. They do not allow any loans to insiders, which typically gets banks in trouble. Now, I tend to have a differing opinion on deposits. I'm generally of the opinion that banks as a whole are commodities. I mean, you're buying money at one price and you're selling it at another. And you have these strong market forces on either side driving the cost down to market or up to market. So on the deposit side, you might have a good branch network, and you have a few banks, historically Bank of America, Wells Fargo, some of these larger money center banks, or even regional banks, US Bancorp, that could get a lower cost of funds through their branch network. I don't think it's as, I think that advantage is going away. And I think if you're a bank like Hingham, yeah, you want to get deposits. It's always great to have lower cost deposits, certainly DDA deposits that are free. But I'm kind of the opinion that the capital will flow where it's can be used best. And I mean, look at Hingham borrowing, they're over $1 billion from the Federal Home Loan Bank. So I'm kind of the opinion that deposits will flow to the banks that can gather them best. They'll work their way through the system, and ultimately to the banks that need them. Finding I mean, you can attract money pretty easily. I think the deposit side is, I don't want to say it's easy, but raise your CD rates, raise your deposit rates. You'll have money flow in. The more important thing is the asset side, making sure your assets are of high quality, have that track record, have a management that just philosophically knows what they're doing and sort of understands these risks. I mean, again, I've seen this firsthand. Competitor comes into the market. Oh, geez, we have a floor on this loan, and we've got a nice interest rate, but bank across, and it's locked in for another 2 years. But geez, some bank just came in and they're offering some crazy rate, and we need to protect our loans. It's such a strong influence. It's such a strong psychological thing to just let a deal go away. So I like the banks that sort of know their stuff, pricing is going to be what it is. And even on the deposit side, you mentioned, Robert, fees. Those are going away too. And a bank like Hingham just says, we're just going to eliminate fees. We're just not going to do fees because they know that they're going away. Just there's a structural uh, competitive force that's eventually going to eat them all away. They'll still be around a little bit, but overdraft fees and things like that, wire fees. I mean, it should not cost $25 if you're a customer to make a wire fee. I mean, it doesn't cost the banks that. So those things are eventually going away. And it's one of the biggest things I look at when I'm looking at a bank is that other income, not interest income. I don't like to see a lot of fee income because um, it's going to be subject to competitive forces. Thomasville, and I'm still kind of on the fence on this. They have a big asset management. They have a big trust department, and so they bring in a lot of fees that way. I did some back of the envelope math on what they're charging their customers, and I think it came out to like 40 basis points. So, and this may be just a rationalization or maybe partly of truth, but I think a small community like Thomasville, to have folks there that can manage money for people, providing a good service, on an average cost of 40 basis points, it's probably adding value to the community. I don't like just pure asset gatherers, because there's that risk too. Again, firsthand experience. I was a loan officer, and one of our goals was bring in investable dollars for the investment guy. Well, why do I want to be doing that, first of all? And second of all, it just doesn't sit for me quite well. You want to do what's right for the customer. Anyways, that's sort of a tangent here on the inside of a bank. And um, again, I think the biggest thing is, are they efficient today? Do they have a pretty low overhead or relatively low overhead, and their loan losses? I mean, I just look to those two things first. If either of them are out of whack, I just kind of move on immediately, and then just kind of dig in. I do like banks, though. I think there's sort of I don't know if this is entirely the best way to think about it, but you basically you can get pretty broadly diversified exposure to economic activity through banks. Yes, they're leveraged, but if you buy a Hingham, they're into multifamily real estate. You buy a Bank 7, which is one that I've covered, I think going on 2 years now, but based in Oklahoma and Texas, and they do hospitality, they do oil and gas. I mean, you can get quite a bit of exposure to economies through banks. Eh, so I think from a sort of purely diversification standpoint, yeah, you might own a couple banks, but you're pretty well diversified if you got a good team behind you and all that. But they can, as Robert said, with Silvergate, go to zero pretty quickly. So got to be careful. This is a good discussion on banks. And any other sort of general banking discussions, questions? Any small banks that you think I should be looking at?
Adam, philosophically, you've picked small banks, and but you're not a believer in the too big to fail, the big money center banks. Seems like their return on equity assets, they seem to have tremendous advantages, and they tend to be a little cheaper than some of the banks that you've selected. So I thought I'd throw that out there.
Yeah, I owned JP Morgan 12 years ago or something like that. I just when I open their report and I look at the number of pages and I see the number of business lines and all of the stuff they're into, it just makes me uncomfortable. Even I mean, I think Jamie Dimon is he's one of the world's best bankers, sort of all time. Even it's still, I mean, they're just into so many different things. I prefer simple, and Um, I mean, I kind of have some indirect exposure through Berkshire Hathaway, owning Bank of America, but um, it's really the complexity that turns me off, Robert. But you're not wrong.
Yeah, it's hard. Like I said, it's pretty hard to look behind the curtain and see what the loan quality is and where their money's coming from, because you can't look at uh, their assets other than in their annual report and their quarterly reports.
Again, a company like Hingham. I mean, I went to the Registry of Deeds uh, in DC when they first moved into that market, and just searched Hingham Institution for Savings, and boop, up pops the deed, and I can see, okay, they've got a loan, in the AFL-CIO building. I mean, that's not going to be in their disclosure, but you can find it. So a smaller bank, kind of, you can, through the back end, just through public filings, real estate filings, you can see the collateral properties that they're lending on. You can see their assets, not holistically, but you get a sense for, all right, is this some rundown shopping mall that they lent on, or something like that, or is this actually a quality asset in a good location, and so forth. And all that's, you do the same thing for JP Morgan Chase. I mean, you never figure it out, and it's the complexity. Again, I like the simple. Um, and some of these are really nice banks, and you alluded to the problem, which is they're pretty expensive. I mean, 3 times book value, 2 times book value. Um, but they're nice little banks. There's certainly nothing wrong with Bank of South Carolina, earning low double digits, 12% return on equity. I mean, it's nothing to sneeze at. If you can get it at the right price, certainly. Go ahead, Steven.
I'm just curious, what do you think that Buffett sees in Bank of America? I know that he sold this Bank of New York Mellon, and I think the Minnesota-based bank as well. I know he sold the J.P. Morgan and Citibank. I think they held and sold. So, what is it specifically about Bank of America that you think that he likes so much?
I think it is. They're probably one of the few banks that does have an actual deposit franchise still, and then they're just not into, in a larger way, um, market making activities and some of the investment banking, that it's simpler. Still complex. They still have, a big derivatives book and all that stuff, but um, I think it's that deposit franchise, and simpler, safer. Yeah. So any good banks, Misha? You got any good banks I should be looking at, or Robert? Any little
I'll,
banks I should be aware of?
I'll throw out. Go ahead.
No, go for it. I'll shut up.
By way of disclosure, I have similar experience to you in terms of being involved in a bank. It's called United Security Bank in Fresno, California. We have 13 branches. I'm no longer involved, but I was involved for a long time. I was lead director, and so I have some experience. That's why I asked you about the loan quality. But United Security Bank is trading at a little over book value. Last year, almost a 20% return on equity, 2% return on assets.
Oh,
with little leverage, and they also have a very good deposit gathering franchise. That's probably the best part of the bank, and the value proposition is, regulators, as you know, hate real estate, and they don't like real estate loans, and that was United Security Bank's forte, still is. And there was a period of time when I was with the bank. That's why I asked you about underwriting. We saw the loans and we saw the properties. They looked great, but the underwriting was terrible. We did a really poor job, and it was approved. United Security Bank, the call sign's UBFO, by the way, if you want to look at it. But they were the regulators approved these loans before 2008. Year after year, quarter after quarter, they approved the loan underwriting until they didn't. And I looked at it and I thought it was terrible the way we underwrote the loans. I mean, you have to be honest with yourself. Loan underwriting's improved tremendously. We had to work through a lot of bad loans, but and that's probably the drawback is because, and the reason they made so much money last year is because a large portion of their loans, they have about a $700 million loan portfolio. $400 million of that is floating rate. And as you said, deposits are not all that valuable, but with United Security Bank, we didn't do any wholesale funding, which, as you know, costs a lot more money than the native deposit gathering, your organic gathering that comes through your bank. But even today, I haven't seen the first quarter, but last year, I think the cost of funds was about 39 basis points, up from 29 the year before, but still pretty low. Efficiency ratios have dropped along with the increase in earnings. We were up in the high 50s. Now we're down in the low 40s. So, loan loss reserves are a little higher because we do real estate, but still not unreasonable. So I'd be curious as to how you compare that to yours, because in my mind, it looks better, and I know the loans, so I know what's there versus guessing. I know the underwriting because I saw the underwriting, and I know how it's done. And so I'd be curious as to your opinion and why you like it or don't like it, based on my little blurb that I explained to you.
Interesting. The same individuals there. You said the underwriting was bad. Did they change the management team, or is it the same management
Not the
team?
management team. The management team largely is intact from when I was there. The person that was running the real estate department at that time was not doing his job. And like I said, the underwriting was very poor, although the regulators accepted it for all that time until they didn't. And we were under an order from about 2011 to 2016 or 17. That's why when I heard Wells Fargo, Charles Schaaf said, well, it wasn't the Charles Schaaf's predecessor at Wells Fargo said, we're going to be out of this order within a year and a half. I said, boy, it must be different for money center banks than it is for small banks, but they're still under the order. That started in 2017. It's been 6 years, and the regulators still don't like them because their I guess their computer network, et cetera, is not up to par. I don't know all the details because they don't tell you that. They just haven't gotten out from the end of the order. They can't increase their assets, which I would think is a tremendous drawback for a large bank. And anyway, so I throw that out there for your level of interest, I guess.
Yeah, I would, knowing you brought it up, and I'll certainly take a quick look at it. That's something I would probably pass on very quickly, based on the facts that you told me. Same management team, run into some trouble, bad underwriting, and now it's better. I'm highly suspicious of that. I really want, unless there's a huge inside ownership, and maybe you can tell me if there is, but
inside ownership's about 35-40%.
Oh wow, okay, that's bigger than I would have thought.
So the order, being under the order, was in we were out 2016, so we've been out for 7 years. I say we, I'm not part of the bank right now, but we've been out for 7 years. Our camel ratings are very acceptable. And if you saw their camel ratings, you'd say, gee, that's pretty good, without the history that I gave you. Like I said, I tried to give you full disclosure, but there's really no issues right now. The underwriting's been amazing. Part is that we survived. We could work through all those bad loans and still have a decent return. Like I said, this year it's the numbers I gave you are pretty high.
Yeah, I mean, we're in a pretty good spot in the credit cycle. So, the big question in my mind, and it would probably make me pass, is just, okay, they got into trouble, they got better, but will it happen again? And that's the big question.
So I got a bank that I should have bought it because I know the majority owners of it. It's called Bank First Corp, BANF. It is in Oklahoma. Very, very, very conservative banking processes. I've never done any numbers on them. I looked at a couple of years ago. I was an idiot. I should have bought it at 20, but now it's up to 89. But those guys are really, really good, and a lot of inside ownership. A lot of inside ownership. I don't know their numbers. Haven't looked at them, but I think I will now. But that's one that I would. That's one that I would definitely take a look at.
BANF, is that what it was?
BANF, yeah. And I know the guys who created it and who are, I think they're either the largest shareholders or they're one of the largest shareholders.
Yeah, I like to see large insider ownership. And when you're lending your own money, you're going to do things differently typically. Although I'm really now my interest is peaked on United Security Bank with such a high insider ownership. What was it, Robert, about the underwriting? How'd they get in trouble? Be an interesting story.
It was just the underwriting was very poor. I mean, they made the loans weren't well documented, so that whole system changed once the bank found out. The system became more robust. The underwriting's a lot better. That's all I can tell you. The loan documentation was so much better, and you can tell that just by the documents you receive for the loans that go to the board. And because typically those are your bigger loans and for bigger customers, and just to see the documentation, and that was available from going back to when the trouble started until more recently. You can look at that and say, this is really a well underwritten loan, which that didn't happen before. I mean, it's like Wells Fargo. You can say, well, Wells Fargo got in trouble at one point, so did Bank of America. But that doesn't deter you from going back and looking at it if things have changed to make it more attractive. And you can tell that by looking at, like you said, what are the loan loss reserves? What's the Oreo property? I mean, you have ways to figure that out. I mean, in terms of the way things have changed. And one of the investors in the bank, one of the owners, they own 10%. They're a company out of Cleveland, and all they do is invest in banks. And so based on his input, they created a spreadsheet of all the banks in California. There aren't that many banks that are over $1 billion in California, surprisingly enough. You'd think there'd be tons of them, but they're not. But looking at that matrix spreadsheet of what the return on equity, size of the bank, number of offices, and that sort of thing, that's why I liked your kind of your Phil Fisher scuttlebutt sort of, just give us the nuggets of summarize it for us, and then your narrative, I think, is very helpful. I think that's a great way of doing it. Anyway, we get that spreadsheet, and you could tell just by looking at it what looked attractive and what didn't. And like I said, everybody's going to be in trouble at some point because it's all people. It's just like Wells Fargo. They created, as Warren Buffett said, the wrong incentives, right? You had to create all these different accounts. You got rewarded for creating accounts, and not everybody is going to be Warren Buffett, where his reputation is the most important thing. Other people are just trying to make a living and do the best they can. So they cheated. But it doesn't mean that Wells Fargo is not going to be a good bank at some point in the future. I mean, they're pretty good right now, but they're going to be better once Charles Schwab gets all this stuff figured out and gets your computer system up to snuff. And I think they'll be good again. Maybe Warren Buffett will invest in them again.
Yeah, no, it's yeah, and Charlie Scharf came from was
Bank of New
a
York Mellon.
Diamond protege.
He was Bank of New York Mellon. That was where he was CEO, because I'm with Bank of New York Mellon. And I was surprised he left to go to Wells Fargo. So I assume they paid him a lot of money to do that. A lot of stock
Probably.
options.
I was just looking up. So was it Strategic Value Bank Partners? Is that who owns?
Yes.
Okay.
It's Ben Makovic.
I'll have to look them up as well.
They're in Cleveland, Ohio.
A note here.
Ben's involved in a lot of banks. They have a lot of banks like you do in smaller areas, and some in the South. I think Georgia. I don't know about South.
Yeah, there's a. I mean, the number is shrinking, but I think there's 3,500, 4,000 banks. I don't know, maybe a third of those public. There's a lot of nice little banks, and the funny thing is, and you said, Robert, the Fresno Bank is 700, 800 million in assets.
No,
Very small.
loans.
Oh,
Assets-
loans. Okay, so maybe a little
Assets
over
are a million
billion.
or $1,350,000, somewhere around there.
Yeah. So even a bank like that, I mean, you hear banks say all the time, "Oh, we have to grow to get more efficient." I mean, these cases that just the two that I wrote up last month, and UBFO that you're talking about, and I assume BANF, small banks, but that doesn't mean you can't generate a pretty good return. And I think there's good opportunity there for value investors. And again, it took me a little while to kind of realize. I said, geez, I should be looking at more banks. I spent time as a banker, and value investors. I mean, it's kind of like me with tech. I tend to just say, no, that's not really my thing. People get turned off by banks, and I think there can be some really good opportunity there for those willing to dig in. So you'll probably see me write up some more banks over time, and I appreciate the feedback on the narrative. I'm not sure, just sort of my own, the way my mind works. I kind of like having these chunks to work through in some of these analyses, which might work better with other companies, but with banks, like I said, the information's largely there. I just pulled some of the information into Excel, made some pretty charts, and um, but no, that's great. I certainly take a look at these ones that we've talked about today, because it's just amazing. I mean, I talk to some people in banking all the time, and you think, oh, geez, have you heard about this bank? You think everybody knows it, but there's just so many of them out there.
If I would throw out that if everything's perfect at the bank, you're probably not going to get a bargain. There's not a value there, and I think it's like your banks that you've picked out. They tend to be a little more expensive, and you put it on the watch list so you can watch it, and hopefully they go down. But if everything stays the same, they're probably going to trade at the same value. I don't see them going down unless something happens, and it could, in major change in the economy, et cetera, could change their revenue, their income, et cetera, and make them less attractive. But typically, you just don't see value unless something there is not quite perfect, because everybody has the same information. It's just how you process it.
Yeah, and I mean, I like, I mean, sometimes when broad-based things happen in the economy and headlines are out there, or if it's a smaller bank as part of, maybe the KBW index or part of the Russell, and then it gets kicked out. There's opportunities when people panic and just, sell banks. I mean, one thing now, and just this bank just came to mind, just we were talking about deposits. A nice deposit franchise is Plumas Bancorp, which I just actually an intern that was working with me for a little while, Christoph, wrote it up, and I forget which issue that was in, but nice little bank on the West Coast, good deposits, and they've just kind of killed it with a nice low cost deposit base. Interesting thing now with banks is the securities portfolio. Seeing a lot of banks take big write downs on their securities portfolio, largely because they're into bonds. Interest rates go up, value of bonds go down. Um, Sort of an interesting dynamic. And someone posted on Twitter, I forget his handle now, but that's only one thing that happens. You don't mark the deposit book up because deposits, low cost deposits are now worth more. So there's other dynamics happening from sort of an economic standpoint. But these banks that were pretty heavy into bonds, longer dated bonds, just really got crushed when interest rates rose. So sort of another interesting dynamic that's happening.
Adam, what was the bank in California you mentioned?
It's called the Plumas.
Plumas?
Let me see. Yeah, let me see if I can find, where did we write that up? PLBC. So if you it's under the June 2021 issue. When I looked at that one, actually, I looked at Bank 7 Corp at the same time. That's the Oklahoma, Texas-based bank. And that was another interesting one. When I actually talked to the president of the bank, I just, a lot of times these small banks, they just list their president or CFO as the investor contact, and he was lamenting the fact that ESG, they were sort of doing road shows and stuff, which I told him, stop doing, just focus on running the bank. But he said all these investors that they talked to, just they didn't want him to make any more oil and gas loans. And at the time, he's like, I know oil and gas; these are strong assets, and you really want a management team that knows the assets that they're putting on the books, and even aren't afraid to sort of stand up to regulators sometimes, because regulators, I've dealt with them firsthand. I mean, they're certainly not going to look at every single asset, but they sort of have their own thing of their own way of looking at everything, and they're kind of more, well, and as they should be, concerned more about the safety of the bank from a depositor standpoint, not from a shareholder standpoint.
What would you say is the most important ratio with a bank? I mean, what ratio would you, I guess, look at first? Because I mean, I'm looking at Bank First, and I'm looking at their non-performing restructuring loans, and in 2022, it's about 25 basis points. So I maybe I'm looking at it wrong. I don't know, but yeah, that's what it looks like to me.
Yeah.
Yeah.
The first thing I look at is actual loan losses, not the reserve, because the reserve is just the accounting change. The reserve is, that's the cookie cutter jar, or the cookie jar rather.
Right.
Release reserves, take reserves. When are they actually charging them off? What does that history look like compared to the market overall? And maybe I'll pull this up. Where is it? I had it in the issue. I'm just going to pull this one up for present my screen here. So again, this is all just FDIC data. The green is the actual net charge off of Thomasville Bank shares. It's not perfect, but I just got the data from the FDIC real estate loan charge offs, and then all charge offs. Just how is the bank doing in relation to peers in the market, just in terms of, because again, look at this tail on the left. I tend to do my graph sort of backwards, but the most recent is here. The industry has had very low loss actual charge-offs. So when you say a bank has low charge-offs now, we're at a good part of the credit cycle, and so you can't really judge what the future is going to hold just based on the last 5 years. You want to know what happened in 2008, 2009. You want it to be the same management team. You don't want them to have moved into another area of underwriting, another market. You want to make sure what you're seeing in the past is the history. The history reflects their current operating plan, if you will. Because if you look at it, say you looked at this graph right here, and you said, "Wow, they have a really good net charge-off ratio." Well, what if they got into crypto lending or unsecured loans, or new management team came in and said, "Geez, we're going to do all these crazy things." They wouldn't say that, of course. They're going to say we're going to do all these smart things. But if something fundamentally changed, you can't trust the record. So that's the first thing. The second thing I would look at is the efficiency ratio. Um, it's really everything. I think when whatever happens competitive wise in the market, I'd rather own a bank that's more efficient. Again, a bank like Hingham can take it on the deposit side because they have such a low expense ratio. Now, both of those things you have to look at in context. So if we looked at, it's been a while since I looked at, well, look at like a Ally or a credit card company or Synchrony Financial, where their charge-offs might be double digits, but that's their business model. Like Hingham's business model is they lend on really good real estate loans. Shouldn't have much actual losses, actual charge-offs. Credit card lenders, auto lenders, it's part of their business model. That's a cost. So it's all relative to history, to their history, and to the market. And then with the efficiency ratio, just be aware that it's non-operating expense divided by the sum of net interest income plus non-interest income. So if they have a lot of fees in that number, it's going to bring the ratio down. So I would tend to take those out or adjust for them, or at least be aware of the contribution of non-interest income. And again, with Thomasville, it's a feature of the bank. They have a trust department. They have this. So just normalizing it and kind of understanding where it is. You can't say, okay, it has to be below 40% for an efficiency ratio. You got to put it in context. But I think those two things as a filter would weed out quite a bit of candidates.
Adam, you said that loan losses in real estate, you said there shouldn't be many losses. Your graph that you showed, I think, looks like many banks. During the banks typically loan, if it's an office building, if you 20 to 25% equity or loan to value, et cetera. But during that period of time, 2008, when everything failed, like your graph shows, 2008 to 2013 or 14, I think that's mirrored by most banks. So there were a lot of loan losses at that time. It depended on how much equity you had in your portfolio. But nationwide, I think the number, and this is going the entire United States, if you had a loan to value, anything below 40% equity failed. So there are a good number of banks that lost a lot of money on real estate because of the loan to value just being too high. In fact, one of my big investments is real estate, and I look for 45% equity because I know pretty well that if in history, loan to value hasn't dropped below that level. So I'm going to be okay, even if unless there's an earthquake or something. That's probably a given in California. It's just a matter of when. But I think all things being equal, if you have 45% equity, you're pretty much going to be in good shape. You're not going to lose money. You're not going to lose your property. And that's pretty much was borne out. I was surprised that the number was so high that you had to have that much equity. I don't know if you are, but I was. And I think if you had that, your customer is going to make it through. So you have to make sure that they have the wherewithal to either put up more capital, because those loans all dropped below 50%, so they had to come up with more capital or their loan wasn't conforming anymore. If you were in banking, then you know that.
Yeah, and here's the problem, Robert. I mean, I live this, and why I admire a bank like Hingham so much. Regulators, you have to have an appraisal on a collateral property if it's over 250,000, something like that, depending. Typically, every single real estate loan gets an appraisal. Well, the appraisers, and this was part of the problem in 2008, and even still is a problem. So, so many times we would see this. Well, geez, recent transactions, they would basically almost always justify the purchase price of the property, the value of the property from a purchase price standpoint, by saying, well, if someone's willing to pay that price, that means that's the market value. And then they do this thing and they look at comps in the area and they justify it with cap rates and property specific adjustments. I would never trust an appraisal. That's why I love what Hingham does. They'll lend to the lower of the appraised value or their estimate of it. They do their own appraisals basically. And that's why I say you really shouldn't lose too much money in real estate. I mean, it does happen, depends on what you lend against. But I would argue that even if the collateral value goes down, that's part of good underwriting, is making sure that you have good tenants, you have good cash flow, good debt service coverage ratio. You don't have your rent rolls aren't turning over in a major way during the term of your loan. What does the sponsor look like? What kind of personal cash flow do they have? I mean, these are the major mitigants to actual loan losses on a real estate portfolio. And then just sort of again, you look at a bank's loan policy, which I'm sure you've seen, Robert. We will lend, up to 75% on commercial real estate. Well, a golf course is commercial real estate. You shouldn't lend 75% on a golf course. Just really digging into it, and you can run a bank like a regulator and just sort of mechanistically, okay, this is this asset, we can lend against this, and this. But it's the folks that really understand their market, really understand the value of these properties that impress me. And I have a very high skepticism, which I think you have to when you're investing in banks, because they can be laden with risks, and you're really trusting the management team to act on your behalf. Yeah, it's get how we got here, but yeah, loans to value, appraisals, and the crazy thing, when I left, the regulators wanted us to hire a third party to review the appraisals that the bank got. Now think about that for a minute. The banker is doing the loan. They sub out to an appraiser to get the appraisal, and then you have to hire someone to review the appraisal. Many bankers, and this is why this comment that Buffett made at one point, there are more banks than bankers, because a lot of them really are just salespeople. They're just selling money, and they're just trying to grow their loan book. So I'm kind of going off on a little rant here, but you want your bankers to think. Is kind of the long and the short of it. And having a big part of your net worth in the bank is a good start. having an incentive to do that.
Some of it, though, I think it depends on the time. I think, like you looked at your graph, that 2008 to 2013 timeline, that wasn't normal. That's why it looks so aberrant in your
Hmm.
graph, because that was a once in our generation probably depression or recession or whatever you want to call it. And what happened during that time, if you were involved, the regulators came down to anybody that had real estate loans, and they pushed the appraisers to drop the value of the properties. They did a lot of things that were just not normal.
Hmm.
Same thing occurred when in the early 1990s. You're maybe too young, but the government basically took out the savings and loan institutions by their legislation. We no longer have any savings and loans. They're either banks or nothing. And so, and the difference was the leverage. Savings and loans, you could lever 33 times your equity capital, which sounds impossible these days, but it drove an entire industry out of business.
Hmm.
And the government did that. They did it
but
themselves.
to your point, and by the way, they did the same thing in 2007, and this is why I dislike, which is an understatement, the government. All they did was just change the definition of a loan. That's all they did. If we didn't have mark-to-market accounting and level 1, level 2, level 3, you would not have had the financial crisis at all. Because to your point, you have a loan in this town that's doing well, and you have a loan in that part of town that's not doing well, but we're going to mark them at the same amount. The reason why bankers weren't willing to make new loans was because they would have to take a hit on they'd have to take a loss on a new loan on day one. And they did that with the FD. They did that just as you described. I mean, I literally was there watching the banks literally default one after another when the night came when they changed the rule as to what is a performing loan in 1994. And one bank after another, gone, absolutely gone. The whole S&L system gone overnight, just because they changed the definition. And guess who made a fortune off of it? Oh, Goldman Sachs again. Right? I mean, I'll tell you something. Do you know how fast Goldman Sachs was ready to create funds dedicated to buy assets from the RTC?
This is last.
They were literally, it took them 3 to 4 months to get a whole team in place to buy assets from the RTC with money. With money.
I was the only one in there too.
Yeah,
Right.
I know some people up here that bought huge industrial buildings for pennies on the dollar during that time.
Exactly right. We did.
They just scooped them up.
You could buy. It was amazing what you could buy. I nearly bought, if you believe it, I was this close in buying, talking about golf courses, PGA West, Kiowa Island, and 2 other very famous properties for less than $15 million. I mean, it's just ridiculous. And that didn't include all the real estate that was there. I mean, shit, all I had to do if I wanted to is get rid of Kiowa and put up new housing there, and it would have cost, I mean, I would have made a fortune, but I didn't do it because I have a rule, which is not to buy golf courses.
That's a good rule. I mean, to Robert's point, you sometimes, I mean, if you have a bad loan and the sponsor isn't paying and you foreclose on it, sometimes you have to sell it. I mean, that's, and if you're in a market that's crazy like 2008, 2009, yeah, you're going to show some losses. And I might have been too strong in that. I think, I mean, you're gonna see some losses, but I mean, just by and large, making sure that you're doing your own underwriting, I guess, is kind of.
Well, I think that to your point, you're absolutely right. Doing your own underwriting is a very big difference between, I mean, I don't know, and you can tell me better, how much of a bank regulation requires an outside appraiser, as opposed to, can banks like Hingham sit there and say, no, we don't want an outside appraiser, we can do it just as well?
No, you need you have it's like by RIA. There's a yeah, you all intents and purposes, you have to have an appraisal. Yeah.
Because when we get appraisals, I could tell you this: the bankers, I mean, to their credit or not credit, they literally tell the appraiser, this is the number we need.
Oh, that's what the appraiser wants to do more work for the bank.
Right.
They're not going to come in with, unless it's wildly out of the realm. I mean, if you're dealing with Wakefield or some of these bigger outfits, they do a pretty good job. But
Right.
some, especially the smaller ones, again, well, geez, if Joe Smith is willing to pay this amount for the property, then that's the market value of it. And well, geez, we had a sale 2 years ago of a commercial property at this much per square foot, and yeah, that seems about right. I mean, they do all these crazy things with cap rates and building up the cap rate. I mean, it's madness. And it just, and if if the property won't cash flow, which is kind of your primary concern, then the value is probably not there. Like, those two things should kind of be in sync, right? If you've got the cash flow and you're lending 75% on a property, you should have a pretty strong debt service coverage ratio.
I
Be
would
around
agree.
1.5. If you don't, something's probably wrong.
Actually, the requirement, Adam, is 1.3 times debt service. Debt service coverage has to be 1.3 times. That's what the regulators look for. So you could fall below that number pretty easily. You said 1.5, but the regulators require 1.3, which, again, I would say you probably, if you had 1.5, you could do the 75%. But if you're 1.3, maybe you want 10% more equity. So 35%. Again, if you look back at history, in the worst time in the world, it was really, you had to have 45% equity to prevent that property from failing. So it just depends on the time. And it's not real. As Michael said before, the regulators did that to us. They pushed the values down because they scared the appraisers. And so you didn't get a fair appraisal. You got a lowball appraisal. And unless you stood up to the regulators, your bank was going to go out of business because you were fighting the government, not the economics. And I think that's the concern with banks. It's a regulated entity, and you have to play in that marketplace.
Yeah, we would typically maybe it's a California thing. We would typically underwrite to 1.2 or 1.25, depending on the asset. But yeah, you're right. I mean, and then there's probability of default, and then there's loss given default. And if you're talking about selling the asset, well, that means it's going to default. You really want to underwrite the loan to make sure that it's not getting a default. They have some cash flow coming in. Then they get creative and do these A/B notes and sell off or charge off the B, or whatever. But yeah, that's on the one hand, you have this nice advantage of having a government sanctioned, government guarantee of your deposits. On the flip side, they can have a pretty heavy hand at times. And so
How much safety do you feel that if a bank has, ability to go to the Fed, right? So in other words, you know, the bank window, the Fed window provides how much safety do you think?
I don't know. I mean, it needs to be tested. I mean, it's.
Right.
I mean, I would argue that they're going to do anything at this point. I mean, Berkshire Hathaway lost out into 2020 because the Fed stepped in and said we'll lend on everything. So that there was their opportunity sort of blown to invest like they did in 2008, $14 billion in the matter of 2 weeks. My guess is that there'll be by far and away more liquidity available. But you don't want to count on that, right? Like you don't want to count on too big to fail. You don't want to count on that stuff not being there.
Well, I mean, you think about Goldman Sachs, right? Was Goldman Sachs really saved by Warren? I mean, I read the when you posted about the testimony that Buffett gave about the failure. And what was very interesting is that, the regulator asks him, the question is, was it you that saved the bank, by you and did you save General Electric and Goldman Sachs? And his answer was smart. He said, I don't know. But, to me, I sit there and I think, well, is it that, or is it that Goldman Sachs was allowed to have a window to the Fed? And I'd argue that when Goldman Sachs all of a sudden, out of nowhere, and I wonder who was Secretary Treasury at the time. Oh yeah, Hank Paulson, Goldman Sachs, right? All of a sudden they become a bank. And oh, by the way, the head of the New York Fed at the time, wasn't he a Goldman Sachs partner too? And bought the shares of Goldman Sachs at this right before this announcement was made? Yeah, I think so. I mean, it's to me, it really was a system of internal corruption, in my opinion, with Goldman Sachs. But again, I think the window saved them at the end of the day, not Warren's, not Mr. Buffett's investment. I think that, but I don't think it saved them.
No, you're probably right. I mean, those loans from Berkshire, that was the Buffett name. I mean, that was just for sure. Well, I should probably wrap up here. This was a fantastic discussion. I'm glad everybody stuck around. I'm glad Misha and Robert, your background in banking, and that was fantastic. That's why I love having these discussions. Just really get to know you guys, really adding a lot of value to me, and I'm sure Stephen enjoyed the conversation. Appreciate you being here, Stephen.
I have a lot more questions, but I'll email them to you. Anybody's coming to Charleston, love to play golf with you, but I won't be there till tomorrow, so don't come today.
I want to come try Rodney Scott's barbecue and Back in the Day Bakery.
That barbecue is really, really good. I gotta say, I went to it before I left, and it's really, really good. It's really good. So I do recommend it. And by the way, I love barbecue. So anybody's got a good barbecue place, you just tell me, and I'll, I know a couple of them in Oklahoma City. So I wherever I go, I go.
There you go. Well,
thanks,
Thank you, Adam.
You're welcome. If anybody wants anybody else's emails, if you don't know how to get in touch with each other, please let me know. Happy to connect you. And see you guys next month. And feel free, again, email me any questions, Misha. Happy to help.
Thank you.
Thank you, Adam.
All right, guys. Have a great afternoon.